Hi everyone, my name is Mark Quinn. I'm a chartered financial planner and tax advisor living and working in Portugal, and I help expats that are relocating to or living in Portugal with their pensions, investments and tax planning. In this video I'm just going to take a quick look at pension options for Portuguese tax residents. So I wanted to do this quick video because I come across a lot of confusion regarding pension options for people living or looking to relocate to Portugal. And the big misconception is that people think that you're not allowed to keep pensions within the UK. Whereas in fact, there's nothing wrong with keeping your pension in the UK. Might not be the best thing, but you're not doing anything illegal by leaving it in the UK. One thing that you need to be careful of is that you're not allowed to contribute to pension schemes once you've left the UK. Or rather, you are allowed to contribute, but you can only contribute up to $3,600 a year gross for 5 years. And after that, you're not allowed to contribute to anything because the tax relief system from a UK context is designed to incentivise UK tax residents to contribute to pension schemes. And obviously, you cease UK tax residency if you're relocating to Portugal on a full-time basis. So what are the options that you have for your UK pension schemes? Well, you could leave it in place. There's nothing wrong with that, as I said. It can stay where it is in the UK. What you may want to do is, if you do decide to leave your scheme in the UK, is just make sure that you review it in terms of two issues. One, it remains competitive from a fee perspective, so you don't want to be stuck in a pension scheme that's has high charges relative to what the markets or what's available out in the marketplace at the moment. And you also want to make sure that your underlying funds are performing well. So what we see is in many cases people end up in what's called a default fund, sort of a default investment fund. Typically isn't the best fund. And you can optimize performance, and even just a few percentage points difference compounding over the next how many years or even decades that you're going to have the pension scheme in place can make a massive difference to your overall final pension pot. So just be careful if you are leaving the pension scheme in the UK, just make sure you're reviewing it to make sure it's still competitive. The second option is actually to transfer the pension scheme outside of the UK. Now, the way in which that's done is through what's called a qualifying recognised overseas pension scheme. So that's a QROPS. And the main jurisdiction for QROPS now is Malta. Now, the issue with QROPS is following the October 2024 budget, the Chancellor introduced a 25% exit charge if you wanted to get your money out of the UK pension scheme across to a QROPS. And this really has made that sort of move a lot less attractive and close the door really for a lot of people. It doesn't really make sense to pay a 25% penalty to remove your schemes from the UK. The only nuance to this is that, again, as a result of the UK budget 2024, the Chancellor announced that pension schemes are now going to be brought into the inheritance tax net from April 2027. So whereas currently they're not subject to inheritance tax if you die, from April 2027 they will be. And that will probably lead some people to think, well, if I'm going to pay 25% to get it out of the UK, but I'm going to save my beneficiaries 40% tax charge, I might very well do it. Now, that's just a general observation, just food for thought. Again, none of this is advice. I just wanted to explain how the lie lands at the moment. And the third and final option is to withdraw money from the pension scheme. Now, a lot of our clients and some of the potential clients we're speaking to at the moment have what's called a non-habitual residence status in Portugal. I've covered that in many of my previous videos. It's a 10-year tax scheme that is available to new residents of the country. And for those of you that got into NHR 1.0, as some are calling it, so the old version of the scheme, it gives you the opportunity to draw down from your pension pot either free of tax if you got in before April 2020, or at a 10% tax rate if you got in after April 2020. So some or many people, in fact, are looking just to draw down directly out of the pension scheme into their own name, take advantage of that nil or 10% flat rate of tax to get it out. Under the double taxation treaty, there is no tax in the UK. HMRC doesn't have the authority under the treaty to levy tax on private pension schemes. Only the state of residence, i.e. Portugal, does. So you're getting it out of the UK tax-free, paying your tax here at a low rate, and then you're able to resettle or restructure that investment into something that's going to work for you longer term, even without an HR. So it's going to be very tax effective. And also at the same time, you're getting it out of the UK tax net and avoiding that IHT charge from April 2027. Now, the other crucial part to avoiding that inheritance tax is that you're going to have to be a non-long-term resident. So you're going to have to be clear of the UK tax system for 10 years out of the last 20. So it's not as simple as just removing the pension scheme out of the UK. You also have to be a long-term non-resident of the UK. If you don't have an HR, then things get a bit more complicated, because you then have to consider the tax you're going to pay to extract the pension scheme here in Portugal. And again, I've covered this in other videos. There's 3 general interpretations for pension income here in Portugal. One is that it's just general income that's added to your scale rates. So the more you earn, the higher the tax rates go, starting at around 13 or 14%, going up as high as 48%. Sometimes it can be treated as investment income at a 28% rate. And then there's the third interpretation, whereby some accountants are declaring pension income on an 85-15 principle. So when you're taking income out of your pension pot, 85% is deemed to be a return of capital and 15% is the investment and taxable portion of any income. Again, lots of nuance, quite a grey area, I think, in terms of pensions and reporting, because what is a pension in the eyes of us coming from the UK isn't necessarily a pension in the eyes of the Portuguese government and the tax authorities over here. So be very careful on that point. But really the purpose of the video was to say, you don't have to worry about leaving your pension schemes in the UK. It doesn't have to move, but as I've said in the video, sometimes it can be beneficial for you, a lot more attractive for you personally and your beneficiaries if you do extract the pension schemes. Please speak to somebody to get personalised advice on this. None of this is advice, it's just information only, and hopefully gives you some food for thought in the planning you're going to do. Thank you.